Good morning, everyone. Can you hear me clearly?
Good morning, can hear you.
Yeah, can you see my screen? My slide?
Yeah.
Okay, good. Then we will start in 5 minutes. So if your friend haven't joined, please remind them to join. Yeah, thank you. Okay, let's start our training today. So once again, good morning, everyone. I'm Jasmine. So our topic today will be accounting for business combination. So what is business combination? Business combination is also called merger and acquisition, M&A. So this is about the accounting when an acquirer obtains control of a business. So our learning objective today is this course will assist you to apply the accounting treatments for different investment. And also we will cover the classification and also measurement of investment. And if there is changes which affect the classification of an investment. And lastly, we will cover the disclosure of investment. And the following standards are covered, which includes MFRS 10 consolidated financial statement, MFRS 11 joint arrangement, MFRS 12 disclosure of interest in other entity, and IAS 27 separate financial statements, IAS 28 investment in associate and joint venture, and MFRS 9 financial instrument, MFRS 3 business combination, and lastly, IAS 24 related party disclosure. So these are all of our all of the accounting standard we will cover today. So after today's course, you will know how to identify the different types of investment and also to determine the relevant accounting treatment for an investment. And third, you will know how to apply the equity accounting method for associates and JV and do the consolidated investment and also assess the accounting implication of change in an interest in an investment. And lastly, to identify the different disclosure requirement for subsidiary, associates, and also joint arrangement. So before we start, just a brief introduction of myself. I'm Jasmine. I'm audit partner of YC & Co. PLT and also a certified trainer of HRDC. Other than that, I'm also the chartered accountant of MIA and a member of ICCA. So I have 10 years of experience in auditing, and my experience is mainly about manufacturing and trading industry for consumer and trading industrial market. So why you must know business combination? Why you must know this? Because we are operate in a high-speed world and we are very competitive. The world is fast-paced and also fast-changing. So the business is no longer operate as a single entity. So they will need to cooperate with others, or they will need to join with others to become more productive or more competitive. So why the business owner look for business combination? Because it helps to eliminate the wasteful competition. They can save the cost of advertisement and also sales promotion, and they can achieve economics of scale because they can bulk purchase the raw material and also economics in their production and marketing and finance. And then they can also explore new market through business combination, create a large entity so that they can raise capital much easily, and the products can be produced on a large scale. And they can also control the market through business combination because they will have monopoly power. And through business combination, they can pool their knowledge and experience with the current competitor. So I see there's a question. The slide will be shared later after the course because I want you all to focus and also to participate during the throughout the training. And then I will share all the material after our session. Okay, thank you. So before we move to our main content today, we do a ice breaking first because we will do a lot of calculation later. So I have to make sure everyone is wake up and also warm up. So please participate actively. The more you participate, the more you learn. So the ice breaking is about we will identify who is the working calculator in YYZ. So it's about math question. So the rule for this ice breaking is you have to apply the order of operations. So do you know what is the order of operations? Okay, still nobody responds to me. So please participate actively, okay? During the ice breaking and also throughout the training. Okay, order of operations is to perform multiplication and division first from left to right before you do the addition and also subtraction. So there will be 5 questions. Who answer yes, Ash is correct. Not must. So who answer the correctly and also the fastest will get a special gift from me, okay? So are you ready, everyone? If you are ready, please type in the chat box yes to me. Wow, okay, thank you. So let's start our ice breaking. Okay, the first question is the easiest one. 3 plus 3 equal to, who is the fastest? Yeah, wow. Okay, Mei Hui is the fastest and the correct one. Okay, so ready to next question? Yeah, and Anthony, this is kindergarten question now. Okay, let's move to the next. Next also consider kindergarten, okay? The next question, 100 times 10 divided by 5 plus 20. How much? Equal to? Wow. Okay, who is the first? Kong. Yeah, Kong answer correctly and the fastest. Okay, 220. Okay, now Mei Hui and Kong are the fastest. We still have 3 more who can catch up. Okay, we move to the third question. So third question is primary question. It's also very easy one. Okay. 1, 2, 3. The third question, 1682 plus 355 times 5 divided by 5. Remember to apply the rule of operation. Wow, the first one is Eric. Okay. So Eric, Kong, and Mei Hui, who is the working calculator or others, who is the working calculator in YYC. Okay, so are you ready to the next one? The fourth question. Okay, let's move to the fourth question. Okay, this one I don't spell out. You all calculate by yourself. Remember, reminder to apply rule of operation. Wow. Agak cepat lah everyone. Wow, why you got different answer one? Okay, maybe we get the first one Lau and also another one LC to share how they get 18100 and also LC how do you get 17272. So Lau, can you share how you get the answer, and also Elsie, how do you get the answer? Because you are the first of different answer. Okay, if both of you are unable to share, then anyone else you would like to share how you get your answer, then we will see what is the difference between the calculation. Okay, Love has shared. So how about those who get 17272? Yeah, the first one Gilbert has shared. The first one, Gilbert, what is your answer? Gilbert. Yeah, the step Gilbert share is correct. Law also correct. So the answer is 18100. So I wonder how the others get the 17272. So I'm curious. So I ask, can anyone share the calculation? So okay, so the prize will go to Lau. Okay, the first one is go to Lau. So now the last question. Ready to the last question. We see who is the working calculator. So now we have Mei Hui, Eric, Lau, and one more. Who is the person already? Yeah, I check later. Okay, so one more prize will go to. Okay, last question. Who is the fastest? This one is similar to the last one. Wow. Lau really sangat cepat, huh? Okay. So he so thanks for all the participants. I will prepare a special gift for those who answer correctly and also the fastest for the 5 questions just now. Okay. So thank you everyone. So have you warmed up? Are you ready to our main session? Simultaneous equation. I will answer this to you later. Okay, so are you ready to our main session today? Have you warmed up? Have you woke up? Okay, so let's start our topic today. So the first one is we will share about the type of investment. So many people might think that investment is about investment in gold, investment in commodity, or government scheme, or etc. Other than that, so we are not going to share about those investment today. What we will share today is about holding company investment. Okay. So what are those type of investment? It includes passive investment, investment in associates, investment in subsidiary, and also joint arrangement. So passive investment is those the holding company or the investor has little power over the entity. And for associate is the holding company can exercise significant influence, which is more power or more control than in passive investment. And investment in subsidiary is the subsidiary is mainly controlled by an investor or a holding company. And the last one, joint arrangement, is a contractual agreement to provide joint control over an entity or an operation. So these are the 4 types of investment. So if we see from this triangle, we can see the top one is the least control one, from the least to the most. So for passive investment, the investor has the least control over the entity. And then the next is associates, they have significant influence, and then joint venture. And the last one is subsidiary, which the holding company has more power or more control over the entity. So this is a brief introduction of the topic the investment we will cover today. So we move to the first one, passive investment. So by just these 2 words, how do you interpret? Just based on your understanding from passive investment, how do you interpret? Okay lah. So passive generate income automatically. Yeah, yes, Qingting is partially right. And what? Sleeping partner. Yeah, sleeping partner. Future money. Oh, yeah, future money. And anything else? Passive investment apa? Yeah, okay. Let's see what is passive investment. So passive investment is the least control and involvement. Yeah, Alexandra generator ROI. This one depends on your luck and also your knowledge. Okay. So passive investment are those investment with the least ownership and also involvement. They don't require to do consolidation for financial statement. They also have no significant influence or control over the entity. And also they do not require for equity accounting. So they have least control, they have least involvement. So that means that they didn't have any power to make decision, and also they don't have control. So no require to prepare consolidated financial statement, meaning that the result cannot be consolidated to the investor account. No equity accounting means they not need to record the share of profit or loss of the investee. So what do they record in the book? We will cover later. So this is an example of passive investment, meaning the entity only hold 5% of another entity. So they don't have control. Also, they don't have the significant because they only hold 5% of the entity. So what they entitle is only the dividend income if the company declare dividend income. If the company declare nothing, then they have nothing. So normally, this kind of investment is like we invest in those listed company on Bursa Malaysia. So when they declare dividend income, then we will get the income only. We don't have a power or control over the entity. We cannot participate in their policy or decision-making process. So passive investment means the investor only accept what has already happened or what the company doing have done. So how do the investor record the investment in their books? So this investment is classified under current asset in the statement of financial position. And also they measure at fair value. And the last one is they have to record the fair value movement through P&L or through other comprehensive income. This is under MFRS 9. So under MFRS, for those instrument which is measured at fair value, they can recognize through P&L or OCI. So the difference is if you recognize through OCI, the profit and loss cannot be recycled to profit and loss, even if the asset is sold or impaired. Okay, this is under MFRS 9. So we won't cover deep about MFRS 9. We will only touch and go. Okay, so we move to the case study. Okay, on 1st of January 2020. ABC Sdn Bhd purchased 100 shares in XYZ Berhad, a listed company, for 120 per share. So what is the entry for the purchase? If through P&L or through OCI, what is the double entry? Auditors, accountant, how do they recognize this in their book? The time can type in chat box. Hello, anyone? ABC purchased 100 shares for 120 per shares. How do you record in books? Yeah, Wai Cheng. Debit investment, credit, cash, or bank. So no matter it is through P&L or OCI, the double entry is the same on 1st January 2020. Okay, let's move to the second scenario. So on 30th June 2020, the share were worth 110 each, meaning it decreased from 120 per share to 110. So what is the double entry? How do they recognize the movement? Through P&L or through OCI? Auditors, accountants, tax agent, and also our expert of YYC. What is the entry for this? The decrease of 10 ringgit for the shares. Okay. Yeah. Wai Cheng and Mr. Chu, very fast. Okay, so for P&L, the change in the fair value will be recognized in P&L for 1,000 ringgit, and also credit the investment for 1,000 to write down the value of the investment. And for OCI, the change in fair value will be recognized in the OCI, and also write down the investment value to 11,000. So the third scenario, so as at year end, 31st December, the share were worth 115 each. That means there is an increase of 5 ringgit each. So what is the double entry? Just now is lower, now is higher. So what is the double entry? Yeah, fetching debit investment. How much? Berapa? 5 increase of 5 ringgit per share. Yeah. Okay, so for the third scenario, debit investment 500, and then if it is fair value through P&L, then we recognize under P&L for the change in fair value for 500. And if it's through OCI, then we recognize in OCI for the change in fair value 500. So what is the carrying amount of the investment as at 31st December? It will be 11,500 ringgit. 11,500 ringgit. So let's move to the last scenario. So on 31st December 2021, the share was sold for 125 each. 100 share sold for 125 each. So what is the double entry here? How do the investors recognize in their account? Macam mana recognize this one? Penguasian, please participate. The more you participate, the more you learn. And also this is also counted in your KPI for the people power training hours. So please participate, fully utilize this session and learn as much as you can. So what is the session? What is the double entry for disposal of share? So yeah, wow, Gary. Wow, suddenly so many. Okay, yeah, Gary answered correctly. Debit to your cash or bank, credit your investment, and then credit the change in fair value for 1,000 ringgit. Okay, sorry. So Gary should be change in fair value, not gain on disposal. Is the change of in gain fair value. So everyone, we recognize the fair value movement, not the gain on disposal. Yeah. So any question about the passive investment? If no, I will move to the next content is about associates. So reminder, we only recognize the fair value movement, even though the asset is sold. So we won't recognize the disposal or the gain or loss on disposal. We only recognize the movement of fair value in your P&L and also OCI. Okay, so if there is no any question, then we move to the next one. It's about associate. So associates are those investment with significant control, with significant influence but no control. And they have the power to participate in the financial and also operating policies decision. And they have no control over those policy and they are required for equity accounting. So they can participate in the decision making, but they have no control over the policies. Okay, Pang have a question. So there won't be gain or loss on disposal if, yes, there won't be gain or loss on disposal. So we only recognize the change in fair value in your P&L and or OCI. For passive investment only, this is only for passive investment. Okay, so for associates, they have no control over the policy, but they can participate in the decision-making process. So they have a significant control, significant influence, but they don't have control. So let's see the example of associates. So this company hold 35% ownership of another entity. So the company, the investors, they have the significant influence over the entity. So this is their associates. So the acquiring company is their associate. So I have one question to all. So what if the remaining ownership is held by 100 people, the other 100 people, the remaining 65% is held by 100 other investors. So do the investor A, this one, they have control over the company? Is this still considered an associate in their account? Yes or no? Do they have control if there is another 100 people holding the remaining ownership? Every answer no. So any other people, yes or no? Do they, will this entity have control? Lau say yes. Any other? One no, one yes. Lawrence say no. Oh, wow. Chu say depends on the controlling power. Any other question? Any other answer? Sorry, not question. Any other answer? Yeah, Pang say depends whether they can make or influence the decision. Yes. So, wow, you all banyak pandai, yeah. So whether this entity have control, it depends on who are those 100 people. If they are from one family or friends or partners, or they are all so individual. So if the remaining 65% is held by 100 other people and which is not related, and this entity have the power or they can influence or make the decision, then they have control over this entity. So this is no longer their associates. This will become their subsidiary. So we have to investigate and also look further into the situation to understand whether this entity is still associate or is a subsidiary of this entity. Okay. So now we determine how do we determine whether there is significant influence. So if the voting power is equal to or more than 20%, then they have the significant influence. If the investor has less than 20% voting power, that means they don't have significant over the entity. So we'll also consider, like what I said just now, whether the remaining interest is held by who are the investor. Okay, how many and who are the investor. So there's also exceptional cases. So this one also need you all to interact with me. So what do you think the following indicate a significant influence? So if there is any representation on the board of director or equivalent governing body of the investee, if the investor has representation on the board, so do they have significant control? Yes or no, type in the chat box. If the investor has representation on the board or equivalent governing body of the investee, do they have significant, is it considered a significant influence? Yes or no? Wai Cheng say yes. So the rest, Hang say yes. Gary and Chu also say yes. Alexander say yes. Okay, wow, really clever, are you? Yes, this is yes. So the second one, participation in policy-making process, including participation in the decision-making about dividends and other distribution. So is this a indication of significant influence? Yes or no? Wow. Wow, this one. Well, now you are faster. Okay, yeah, yes. All answer correctly. Yes. This also an indication of significant influence. So the third one, material transaction between the investor and the investee. So is this a factor of significant influence? I'll say yes. How about the rest? Material transaction, is it considered a significant influence? Gary say yes. Wow. Yes. Yes, this is. So the next, interchange of managerial personnel. If you can exchange the managerial personnel, so is it a factor of significant influence? Yep, yeah, Lau say yes. The rest, yes or no? Wow. Gary, I don't know. Okay. B, yeah. True, yes. Okay, yeah. Alexander, yes. Yeah, so Gary, this is yes, because you can exchange the managerial personnel. That means you have the significant influence over the entity. And the last one, provision of essential technical information. If the investor, they can provide technical information to the investee, is that an indication or factors of significant influence? Provide information. Yes or no? B say no. Okay. How about the rest? Yes or no? I don't know. Okay. Mu say no. Gary, yes. Okay. So if the investor, they provide essential technical information to the investee, yes, it is is an indication of significant control, because the investee will have to depend or rely on the investor technical information. So is this so all of the following are considered in determining whether the investor has significant influence. So Yanping has a question. So how the material transaction between the investor and the investee is considered as significant influence? Okay, so material transaction, firstly, we have to determine how to justify whether there is material transaction. So we have to see how big is the company. Okay, so if the transaction between the investor and investee, for example, the investor sell about take about more than 10% of the investee sales account. That means the investee sells to the investor more than 10% of their total sales. That means they have a material transaction, because if the investors stop buying from the investee, the sales of the investee will be dropped by at least 10%. So they have the significant influence over the investee. So we will have to see how material is the transaction. If they maybe only sell 2% of the total sales to the investor, then it is not considered as material. Okay. We not only look at sales. This is only one of the example. We also look at other things like purchase or anything that if the transaction will affect the company operation, or if there is only loan, the loan or borrowings from the intercompany, then if the investor stop the loan, then it might affect the company performance, then also it will consider as a material transaction. So Kang asked how to justify 10 or other rates is material. So this is very depends on our professional judgment, because we really have to see the case, how big is the company. So is 10% is material to the company, just like how we set the materiality. So Wai Cheng has also asked a question: what are the possible advantage or disadvantage of the control, even though the shareholdings are not more than 20%? Maybe I will answer this to you later. Okay, let me think about it. Okay, so let's look at a case study here. So ABC Sdn Bhd, they have 10.1% share of in XYZ Sdn Bhd, and ABC is responsible for 18% of the sales revenue, and 2 of the 10 board of members of XYZ are representative of ABC Sdn Bhd. So does ABC Sdn Bhd have significant control of XYZ Sdn Bhd? Yes or no? Type in the chat box. They hold 10.1% share. They are responsible for 18% sales of XYZ, and they have 2 representatives in XYZ. So does ABC have control of significant control of XYZ? Gary say yes. So the answer is yes, because they have representation on the board, and also they contribute to XYZ performance. Okay, so what is the accounting entry for associate? So for associate, we recognize at cost, because one reminder, associate will have to apply equity accounting. So for associates, we recognize at cost. So the carrying amount will be increased or decreased based on the investor share of the profit or loss of the associate, and also based on the distribution received from an associate. And also they will have to take into consideration the change in associate OCI that have not been recognized in the associate's P&L. So what is the difference between passive investment and associates accounting treatment? For passive investment, we only recognize the movement of fair value. So if in passive investment, the company declare dividend, we will just recognize it as a dividend income. And the movement of fair value, we will recognize in P&L or OCI. But for associates, we will recognize the share of their profit or loss, and also the dividend, and also the changes in the associates OCI in their carrying amount. So we look at the case study here. ABC Sdn Bhd pay 100 ringgit for 33% of PQR Sdn Bhd. So the entry will be debit investment in PQR Sdn Bhd for 100 ringgit, and then credit cash or bank for 100 ringgit. So the next 1 year later, PQR has made a 30 ringgit profit. So can mute your mic. What is the noise? Okay. So PQR has made a 30 ringgit profit. So how much will ABC share of this profit? Answer already written there. Can anyone type in the chat box? PQR has made a profit of 30 ringgit. So how much ABC share from the profit based on their shareholding of 33%? Yeah, 10 ringgit. So we debit to the investment 10 ringgit and then credit to the P&L profit from PQR Sdn Bhd 10 ringgit. So we recognize the carrying amount of investment in PQR will become 110 ringgit. And then PQR decide to pay dividend of 15 ringgit, and 5 ringgit will go to ABC Sdn Bhd. So there's income from the investment. So this investment, this dividend will reduce your investment value. So debit cash 5 ringgit and then credit to your investment in PQR 5 ringgit. So question, what is the carrying amount of the investment in PQR now after the dividend payout? Initial investment 100 ringgit, and then share of profit 10 ringgit, and there is a dividend payout of 5 ringgit. So how much is the carrying amount after the dividend payout? Robert, type in chat box. Yes, 105. Hang is the fastest. Yeah, Wai Cheng also. Yeah, Lidi. Yes, you all are correct. 105. So after the dividend payout, the carrying amount of the investment in PQR is 105 ringgit. So any question regarding the associates? Other than the Wai Cheng asked about the advantage and also the disadvantage? Okay, Ki Kyung say no. Okay, so if there is no any question, then we move to the business combination. We will have a short break after the business combination. Okay, so now we talk about business combination. So what is business combination? So first we have to look at the definition of business. So business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to customers and also generating investment income or other income from the ordinary activities. That means that business are those activities that making money through producing or servicing or buying and selling products. And these activities is to make profit, make money. So the keywords is provide goods and services and to generate income. So this is business. So business combination is a transaction or other relevant event in which the obtain control of one or more businesses. So if the acquirer, they buy another entity which do not generate investment income or do not providing goods or services, then it only consider as acquire of an asset, not consider as a business combination. Business combination is you acquire another business which for the purpose of providing goods or services and generating income. Okay, so these are the keywords for business combination. So there are 4 steps to the acquisition method of accounting. This is to recognize the acquisition in the account. So step 1, we have to identify the acquirer. So who is the acquirer? The entity obtain the control is the acquirer. And step 2 is to determine the date of acquisition. So it is the date that control is obtained and also the consideration is transferred. That means the date you pay and also you obtain the control of the entity. So it's the date of acquisition. And step 3, recognize the identifiable assets, liability, and non-controlling interests. So step 3 is you have to recognize the assets and also liability at fair value and also to measure the non-controlling interest at fair value or proportionate share of the non-controlling interest. And step 4 is to recognize or measure the goodwill or gain on bargain purchase. What is gain on bargain purchase? Gain on bargain purchase is negative goodwill. That means you use a lower consideration to take over other business. So these are the 4 steps of acquisition method of accounting. Then we move to one case study. So Lim Sanya Berhad, they acquire Lim Berhad, they acquire Lee Berhad. Okay, so they acquire 70% of Lee Sanya Berhad for 60,000 cash consideration, and they use 10,000 shares to buy Lee Sanya Berhad. So as at the date of acquisition, the fair value of the net asset of Lee Sanya Berhad is 90,000, and the fair value of NCI is 28,000. So now we calculate how much is the goodwill by 2 approach. One is proportion of net asset and another one is NCI at fair value on acquisition. So, okay. So first we see how much is the consideration, 60,000 cash consideration and another 10 share of Lim Berhad, which worth 1 ringgit and 20 cents each. So the 10 share total worth 12,000. And then we look at the fair value and also the fair value of NCI is 28,000. So how much is the NCI if it is measured under proportionate of net asset? Are you following me? Or I have to slow down a bit? Are you all okay? Wow, okay, phone very fast. Yeah, 27K. So if the NCI was measured as a proportion of net asset, the NCI is 27,000. So if under fair value, then it is 28,000. Then we minus the fair value of the net asset acquired, 90,000. Then we get our goodwill acquired. So under proportionate under proportion of net asset is 9,000 ringgit. If it is under fair value is 10,000 ringgit. So my question to you all now, do you know why there are two approaches to measure NCI, non-controlling interest? Or when to use proportion of net asset or NCI at fair value on acquisition? Okay, so let me explain a bit here. Okay, so there are two approaches to measure the NCI, non-controlling interest, just like what we shared in the yeah, okay, wrong answer. Just what we shared in the slide just now. There are two ways to measure the non-controlling interest. So if we measure at fair value, the fair value is normally determined by the directors of the acquiring company. That means it's determined by the directors who sold the share of Lee Sanyang Berhad. If it is measured as a proportion of net assets, then it is to the fair value of the net asset. So this is fairer, and also we call this as a partial goodwill method, and also this is UK method. And for NCI measure at fair value is full goodwill method. So you will see if the NCI is measured at fair value, the goodwill will be higher than the NCI measured at proportion of net asset. So we look at one more case study, but this one you have to involve more calculation, yeah. Okay, Moon Sanyang Berhad acquire 80% of Star Sanyang Berhad for 2,145,000. So at the date of acquisition, Star Sanyang Berhad has a fair value of net asset 2,170,000, and the fair value of their NCI is 683,000. So how much will be the goodwill if the NCI was measured as a proportion of net asset or was measured at fair value? So how much is the cash consideration? And how much is the NCI as a proportion of net asset? Yeah, 1,214,5,000. Yeah, and then 2 million. And then how much is the NCI as a proportion of net asset? %, times 2,170,000. How much is the amount for NCI as a proportion of net asset? Hello? Are you all still there? Yeah, 434,000. Okay, 434,000 is the NCI as a proportion of net asset. So how about the NCI at fair value? What is the NCI at fair value? Yeah, now 683,000. Okay, so we minus the fair value of the net asset acquired. Yeah, Alexander also correct, 683. So we minus the fair value of net assets. So fair value of net assets is 2,170,000. So what is the goodwill under NCI as a proportion of net assets? 2,145,000 plus 434,000 of NCI minus the fair value of net asset 2,170,000. So what is the goodwill acquired under NCI as a proportion of net asset? Okay, working calculator missing already. Yes, Eric. Now your one is under fair value. Okay, yeah. So if under proportion of net asset, the goodwill will be 409,000. So if under fair value, the goodwill will be 658,000. So which means that if it is under fair NCI at fair value, and the director determine a higher fair value for NCI, then your goodwill will also be higher. So if under proportion of net assets, your goodwill will be lower compared to the NCI at fair value. So these are the two methods to measure the measure the NCI and also the goodwill. So for the disclosure requirement for business combination, the acquirer will have to disclose the information which includes which enable the user to evaluate the nature and also the financial effect of a business combination. Either it is during the current financial period or after the end of the reporting period, but before the issue of financial statements. So the acquirer, the holding company, they will have to disclose the nature and also the financial effect. If the business combination is occurred during the current financial period, or even it is after the end of the reporting period, but is before the financial statements are authorized for issue. So what needs to be disclosed in your in the acquirer financial statement includes name and description of the acquiree, and the acquisition date, and the percentage of the voting equity interest acquired, and the reasons for the business combination and how the acquirer obtain the control, and a qualitative disclosure of factors that make up the goodwill, if there is any, and so if the details of any contingent consideration. So contingent consideration is are those like there will be a further consideration given to the acquiring company if they meet some KPI, like they hit the target sales or they hit the PBT, then the acquirer, they maybe will have another further consideration or another payment to the acquiree. So this will have to disclose in the financial statement, and also to with a description and also the basis for determine the payment. So up to now, any question about business combination? Because after this, I will cover about control and also the power. Are you still following me? Or I need to slow down a bit? Okay, no question. Ki-kyung, yes. Okay. Chloe say no question. Okay. If everyone is okay, then I will continue to the control part. Okay, so now we look at control. So how to determine control, whether the entity have control. So we have to assess the purpose and the design of the entity to assess whether there's power. So how to determine whether there is power? We have to look at what are the relevant activities, means that any activities that significantly affect the investee returns, and whether who make or how to make the decision about the relevant activities, and whether the investor have the rights to direct the relevant activities. And then after we assess the power, we'll also have to assess the exposure to variable returns. So we'll cover detail later, and also we'll have to assess the ability to use power to influence a variable return. So the first one, power. So what is power? Power means your voting rights, and also any potential voting rights or any other contractual arrangement and a combination of the above. So if the voting rights mean the share, if you have the ownership of the share, this is the most direct one. And the potential voting rights are those convertible debts or share options, which can be converted to ordinary share, means the ownership and also the voting rights. So this will affect or influence the company voting power. And then other contractual arrangement are, for example, like if they have the power to appoint or remove the board of directors or other body that involved in the financial or operating activities. And another example for contractual arrangement is whether they have the power to determine the financial or operating policies. So we have to consider these three things, because all these right, they causing power. So this is the first part, power, and how the decision is made, whether the investor can make the decision. So after we determine the power, assess the power, and then the next is assess the exposed to variable returns. So what are the returns? Returns include the change in the value of the investment, and then the dividend, how much they get from the investee, and interest, and also management fee, management or service fee, and guarantees or other returns. They may not be available to other interest holders. So these are the returns. So we have to assess the exposed to variable returns of the investee. So the last one, we have to assess the ability to use power to influence the variable returns. So what does this mean? These are the investee key management personnel are related party of investor, or the economic dependence on investor, or the investee activities conducted on behalf or involve the investor. So other than that, it also, like if the investor can appoint the key management personnel, or the investor can direct the investee to enter into a significant transaction, and also they can nominate or dominate the nomination to members of the governing bodies. So if they have the power to appoint or remove people from the management, that means they have the ability to affect the returns. So now we look at example, or we can also call case study. So entity A and entity B both hold 50% of the real estate property trust. And then entity A has been appointed manager of the property trust. So both have the share, both they have the same voting power, 50%. But entity A have been appointed manager of property trust. So who has the control over the real property trust, A or B? Please type in the chat box. A. Okay. Eric say A. Lim also say A. Okay, someone say A. Anyone say B? Okay, someone say A. Okay, why A? Okay, let me explain why A. Okay, so if the manager does everything, including making this strategic decision, then entity A has the control. So we will have to look at the management agreement to see what is the scope of a manager, what is the capacity of a manager. So if they can make the strategic decision, then they have the control. Okay, let's look at one more example. Company DEF, they hold 69% of company HJK. So they can appoint one out of four of the directors of HJK. But under the HJK charter, they have to obtain 75% shareholder approval to rectify any dividend decision or any substantive change to the charter. So does company DEF have control over company HJK under this case? They hold 69%. They can appoint one director. And say yes. Who say yes? Any other question? Any other answer? Chu also say yes. Mei Hui also say yes. Oh, wow, wow. Semua orang say yes. Anyone say no? Anyone say no? Ada tak? Or semua orang say yes? Yes, you can. Okay, come, let's look at the answer. No, DEF does not have the control of HJK because it can only appoint one out of four of the director in HJK. And because of this rule, 75% shareholder approval is required for the dividend decision making and any substantive changes. So their shareholding is insufficient to put the company to be able to affect the return of HJK. So they only have significant due to their shareholding 69%. So this is an associate of DEF. So, okay tak? Boleh tak? Follow tak? Any question? Okay. Okay, so if no more question, then we take a 15 minutes break. We will come back at 10:40 a.m. Okay, so we will cover subsidiary and also the consolidation and joint venture later. So, okay, we have a break now. Thank you, everyone.
再一起量一减。哦，因为他那时候没有恰恰，他没有。
Hello, semua orang balik? If yes, can type in the chat box to inform me. If everyone ready, we will start the next session. Okay, thank you, Mei Hui. Thank you, Wai Cheng. Thank you, Liu. Okay, thank you, Ashley. So, okay, so we will start the next session. So this, for this session, require your full attention because this is more complicated and also will also require a lot of calculation, okay, for the subsidiary, and also for our following session is about change in investment. So now we will talk about subsidiaries. So what is subsidiaries? Subsidiaries is an entity that is controlled by another entity. So the entity who controls a subsidiary is known as a parent company or holding company. So the under MFRS 3, the difference between the end of the reporting period of the subsidiary and parent cannot be more than 3 months. And also the length and any difference between the reporting period is required to be the same from period to period, which means that when you do consolidation, you are getting 12 months result to combine with subsidiaries 12 months result. And the months, for example, your year end is December, but the subsidiaries year end is in March, then you have to get the subsidiary result from January to December to do your consolidation. So the length of the reporting period, 12 months, and any difference between the reporting period is the same, to be the same from period to period. So this is an illustration of the relationship of parent and also subsidiaries. So the top here is parent or holding company. So they will hold many or maybe one of the subsidiary or more than one of the subsidiary. Then the subsidiary can hold another subsidiary. So all of the companies under the holding company is called subsidiary. So same goes to the subsidiary A. If they hold subsidiary C and D, so for C and D, subsidiary A is also a holding company, but their ultimate holding company will be this one, the parent, the holding company of subsidiary A. So if there is holding and subsidiaries company, the holding company is required to do consolidation. So what is consolidation? Consolidation is to combine the result of the holding company and also the subsidiary company. So in the financial statement of holding company, there will be group results and also company result. So when the parent company, they do the consolidation, they will need to follow this step. So the first is they will have to take in any additional assets or liability arising on the consolidation. And these assets and liability are recognized at fair value. And the parent investment in each subsidiary will be eliminated against the parent portion of the equity in each subsidiary. And the goodwill or the gain on purchase is recognized. This means that the investment will be eliminated against the equity of the subsidiary. And any difference will be recognized as good or negative goodwill. Adjustments are made to recognize any periodic depreciation necessary, consistent to reflect the acquisition date adjustment to assets and liability. This is for intra-group purchase of assets. And the next is all transactions and balances between the entities in the group are eliminated. That means the intercompany transaction and balances are eliminated when you prepare the consolidation. And the last one is the non-controlling interest in the net assets of consolidated subsidiaries are identified separately from the parent's ownership interest in them. So these are the steps when you prepare consolidation. So we will look further in the later session. So please pay more attention. So now we also cover some special treatment for intra-group transaction. So for example, if there is intra-group sale of inventory, we will need to eliminate any profit or loss arising from the transaction if the asset is still held by the group. And we only recognize those inventory which is sold to an external party to the group. And same goes to the intra-group sale of depreciable assets. We need to eliminate any gain or loss or profit or loss arising from the transaction. So we also have to calculate the depreciation based on the cost of the asset to the group before the intra-group sale. So if there is any dividend payment by the subsidiary after the acquisition, meaning from the post-acquisition profit, then there will be no unrealized profit because the dividend will be eliminated against the group income. And also for the intra-group interest, the transaction, both the revenue and also expenses are eliminated in your consolidation. And for the intra-group provision of service, for example, management fee, holding charge management fee to the subsidiary. So this transaction will also be eliminated in consolidation. So we look at case study here. This is about the intra-group sale of inventory. So on 1st Jan 2020, sorry, this is about acquire of subsidiary first. Okay, on 1st Jan 2020, Tiger Sdn Bhd acquired a 35% interest in a subsidiary CAT Sdn Bhd for 120,000. So on the date of acquisition, CAT Sdn Bhd had a share capital of 50,000 and a retained profit of 70,000. So the net asset, fair value net asset of the CAT Sdn Bhd is 120,000. So if there is no fair value adjustment, and so what is the journal entry in holding company and also to the consolidated worksheet? So on 1st Jan 2020, we debit in holding company, we debit investment in CAT Sdn Bhd and then credit bank for 120K. So under consolidated financial statement, because as here we say we will have to eliminate the investment against the equity of each subsidiary and recognize the goodwill or gain on purchase. So under consolidated financial statement, we will have to take out the share cap of subsidiary and also the retained earning of subsidiary. This is pre-acquisition profit and the net asset at the date of acquisition. So we take out their net asset and then credit to investment in CAT Sdn Bhd. This is to eliminate the investment. And then we calculate the non-controlling interest. This one is based on proportion of net asset. So their net asset is 120,000. So what is the non-controlling interest? How much is a non-controlling interest? Anyone can type in the chat box, even though I already shared the answer just now. How much is the non-controlling interest? 30K. Yes, Eric. Yes, working calculator. Yeah, non-controlling interest is 30K. So how much is the goodwill? Consideration plus NCI minus the net assets of the subsidiary, net assets of the subsidiary. So how much is the goodwill? Yes, Eric, 30K. Yeah, so debit goodwill, 30K, and then credit to NCI, 30K. So this is under consolidated financial statement entries to eliminate the investment. So in holding company, they have to recognize the investment, but in consolidated, they have to eliminate the investment. So the next, on 31st December 2020, Tiger sold inventory with a cost price of 10,000 to CAT for 15,000. So as at year end 31st December, none of this inventory had been sold by CAT. So this is about the intra-group of sale of inventory. So what will be the entry? So on 31st December, for the under holding company account, we will have to recognize the sales. So we debit bank, credit sales, 15,000. And then we recognize the cost of sales, debit cost of sales, and then credit to inventory, 10,000. So there is a profit of 5,000. So under consolidated financial statement, we have to eliminate this transaction. We have to eliminate the intra-group sale of inventory. So we take out the revenue, 15,000, and also we take out the cost, 10,000. And then we have to lower the inventory cost to 10,000. So we credit inventory to 5,000. So debit revenue, 15,000, credit inventory 5,000, and then credit cost of goods sold 10,000. So up to here, any question from the floor or anyone need further clarification for this transaction? You can type in the chat box and then I will explain again. If no question, can you just reply no? Okay, no question, yeah. Okay, so up to here, okay, yeah. So through the elimination entries, then we also take out the profit of 5,000 because we take out the revenue and also take out the cost. So the profit will be lower by 5,000. So the unrealized profit we have already taken out from the consolidation. So the next, CAT management declare a dividend of 10,000 out of the post-acquisition profit. That means after the acquisition, they declare a dividend of 10,000. So the entry in holding company is debit bank 7.5 thousand, and then credit to dividend income 7.5 thousand. Can anyone tell me how to get this 7.5 thousand? Can type in the chat box. Any expert can explain this? Yes, we 75% of ownership. So we use the dividend times 75% of shareholding. Yeah, yes, Sim, yes, Fong, yeah, expert. So holding only get 7.5 thousand dividend. So under consolidated financial statement, we also have to eliminate this income. So we debit the dividend income 7.5 thousand and then debit to non-controlling interest 2.5 thousand because they have the dividend income of 2.5. They have the 25% interest, and then credit to dividend paid 10,000. Okay, so let's look further. Net a net profit of 30,000. Included in this net profit is a gain on the sale of inventory to Tiger for 15,000. So as at December 2020, none of this inventory have been sold by Tiger. So what is the attributable share of consolidated profit to NCI? Okay, so CAT made a net profit of 30,000, but out of the 30,000, the gain of sale intra-group sale of inventory is 5,000. We use this 15,000 minus by this 10,000 the cost. So the profit is the unrealized profit is 5,000. So 30,000 minus 5,000, and then we times the NCI interest 25%. So this is the NCI share of profit 6,250. So we debit to retained earning and then credit to NCI in the consolidated financial statement. So for consolidation, do you all have any question? Any question about the elimination or any entries you are not clear? You don't understand? If no, then I will proceed to a more challenging part. Are you ready for this? If yes, please type a yes. Yeah, Eric is yes. Wei Cheng is also yes. How about others? Are you ready to a more challenging part? Yeah, okay, Alexandra Chu, Fong Pang, yes, yes, yes. How about others? I have 200 over participants, but only a few of you reply me yes. Okay. Yes, so yeah, thank you for the response. So this is a more challenging session because this is about the changes in the classification of the investment. So there is a changes because there is changes in the equity interest, which will cause a change in the classification of the investment. So change in equity interest, that means there is a change in control. So this is a significant economic event. So change in control will be, there will be two scenarios for change in control. That means when the control is achieved or when the control is lost. So can anyone type in the chat box to answer me why there is a how the control is achieved or why the control is achieved? Can anyone give an example or anything? Or just say no, I don't know, also okay, at least I know. So how to say when control is achieved? How to achieve control? Yeah, holding more share. Yes, so changes in equity interest. You buy more shares, you have the voting power, then change in the control. So control is achieved. And when control is lost, how the control is lost? Anyone? Hello, Kawan. When control is achieved, is you're holding more share. How about control is lost? Selling off, yes. Less share, yes. Because you're selling off the share. So changes in, the main point is changes in equity interest. And when the company, they issue more share, then you have less holding power. Okay, so the control is lost. So when the control is achieved, there are two steps. You have to identify the goodwill and also to remeasure the net asset to fair value. When you lost the control over the company, you have to remeasure the residual value to fair value. So the keywords here is when your control is achieved or lost, you have to remeasure to fair value. So now we look at when the control is achieved. So how to determine when the control is achieved? So that means you're holding more shares. So like investment you hold from passive investment, and then you increase your shareholding to associates or to subsidiary, or you hold a company which is under associates, then you increase your shareholding to become a subsidiary. Okay, so the value of the existing investment will be remeasured to fair value at the acquisition date. At the acquisition date means the date you increase your shareholding, and any gain or loss will be recognized in profit or loss or OCI. And any gain previously recognized in OCI are recognized on the same basis. That means if it is under passive investment and previously you recognize the gain on fair value in OCI or P&L, then it will still be the same basis. Okay, so now we look at the case study. So entity A acquires a 15% shareholding in entity B in 2019 for 2,000 ringgit. And then after 2 years, they decide to a further acquire of 85% for 25,000. So that means they want to hold 100% of entity B. So the fair value of entity B as at the date of acquisition was 15,000. So what is the profit or loss on the purchase? So first, we have to remeasure the previously held interest to fair value, the first step. So what is the formula is we will use the purchase price of additional ownership divided by the newly acquired ownership percentage of ownership interest, and then we times the previous held ownership interest. So the purchase price of additional ownership is 25,000. And then the newly acquired percentage of ownership, 85%. And then we times 15%, which is the ownership originally held by them. So the fair value of the previously held interest is 4,412. Okay, and then second, we determine the total consideration paid on the acquisition. So how to calculate? We use the fair value of the 15% shareholding in 2021, and then we plus the consideration we use to buy the further 85% of the holding. So $4,412, the fair value, current fair value, and then we plus the consideration paid for additional shareholding, and then we get the total consideration is 29,412. So yeah, anyone anyone have question, or am I too fast? Is it okay? Yeah, no response means everything good, huh? Okay, then the third step, we determine the goodwill or gain on purchase. So how to determine? We use the total consideration minus the fair value of the net asset acquired. So total consideration is here, 29,412. So what is the fair value of the net asset acquired? Can anyone tell me what is the net fair value of the net asset acquired? Type in the chat box. Anyone? What is the fair value of the net asset acquired? Yes, Alexander, 15K. So the fair value of the net tangible asset as at the date of acquisition was 15K. So we use the total consideration minus the fair value of the net asset acquired, then we get our goodwill, 14,412. So everybody okay? Because only Alexander answered me. Are you following? Okay, can I expand on the 4,412? Okay. So because we have to remeasure the previously held interest, we have to remeasure this 15% because we acquired in 2019 for 2,000. So we have to know what is the value when it was in 2021. So we use this formula to calculate. We use the purchase price of additional ownership, 25,000, and then we divided by the newly acquired ownership interest. Because this is the current, we treat this as the current fair value because this is the consideration we paid to purchase further interest, and then we times the originally held interest 15%. So 25,000 divided by 85% and times 15%, then we get 4,412. So this is the fair value of the previously held interest. It's been, we use the current NA to set to not current. This is to verify the consideration. Okay, we consideration and the net asset should be a different thing. Okay, should be a different thing. So the net asset is the company value as at the date of acquisition, and the consideration is how much the the entity A is willing to pay. This is the consideration. Then that's why there will be a goodwill on the purchase. So is it okay? Okay, so is there any other question? Seem okay, if not okay, then you can PM me later, also okay. Okay, so okay, after we determine the goodwill, total consideration, and also the fair value of the previously held interest, so what will be the entry in both holding company and also the consolidated financial statement? So in holding company, we will have to increase the investment in entity B, increase the carrying amount. So we debit investment in entity B for 29, for this amount, 29,412. And then we credit cash because this is the consideration we paid to increase our interest, 25,000. And the change in fair value will be credit to P&L or OCI on the same basis as you used to recognize your passive investment. So 4,412. So this is under holding company financial statements. And for consolidated financial statements, because after you further acquire the shares, it becomes your subsidiary, so you have to prepare the consolidated financial statement. So debit net asset of entity B is actually you take over all of the asset and the liability of entity B. So this is the net difference, okay, of 15,000, and then debit your goodwill 14,412, and then credit to the investment in entity B to eliminate the investment. So the net asset here is actually your share the share capital and also the retained earning of entity B. The initial investment of 2K. Oh yeah. Oh. Okay. Oh, so yeah, you remind me. Yeah, no, there's no the 2K actually already included under the 4K. It should be, this one should be the change in fair value should be lower because this is the current how to say, the current carrying amount before they increase the interest. So this is the carrying amount. This one is true. Just the movement here should be 2,412 only. Yeah. Yeah, Yanping. Luckily you remind me. Yes. So under the holding company, we debit only 27,412. Yeah, your entry is correct, but the debit should be 27,412, and then you can take out the credit investment 2K. But for the elimination, it's the same. The elimination should be, we will take out all of the portion of the investment. Yeah, I will amend this slide later. So, and then only send to you all. So any other question? If no, then I proceed to the next. Okay, so this one is from associate become subsidiary. So Zoo Sdn Bhd on the 1st January 2018, they have acquired 30% equity interest in Lion Sdn Bhd for a cash consideration of 100,000. And then after 3 years, they further acquired another 50% equity in Lion for a cash consideration of 215,000. So Lion total profit from 2018 to 2020 is 55,000. So determine the goodwill arising from the acquisition of control from 30% to 80%, meaning from associates to subsidiary. So the fair value of client's net asset on 1st Jan 2018 is 310. And then on the 3 years later, on 1st Jan 2021, the fair value become 410. And then the NCI is measured at fair value for 86,000. And previously held interest is at fair value 123,000. So first, we will have to determine the carrying amount as at the date of further acquisition, meaning on 1st Jan 2021. So we have to use the initial investment plus the share of profit. So initial investment 100,000 ringgit, and then plus the share of profit, which is 55,000 throughout the three years, times their shareholding 30%. So it's 16,500. So the carrying amount as at the date of acquisition is 116,500. This is the carrying amount of the investment in associate. So second, we have to determine the amount to be recognized in the P&L or OCI in relation to the second purchase of the Lion. So fair value of the previously held interest, then minus the carrying amount of the investment, then it will be the amount to be recognized in P&L. So how much is the fair value? Is the previously held interest 30%, fair value is 123,000. It is given here, 123,000. So 123,000 minus by the carrying amount 116,500, and then we get the 6,500. This is the profit on purchase. So third, we determine the goodwill arising from the acquisition of control. So we have to use the fair value of the additional 50% controlling interest added by fair value of the 30% previously held interest, and then also add on fair value of the NCI, and then we minus the fair value of the net asset as at the date of acquisition. Then we will get the goodwill. So the fair value of the additional equity interest will be 215. And then we have to add it by the fair value of previously held interest, 123,000. And then fair value of NCI also given in the case study, 86,000. This is determined by the director of the subsidiary. And then we minus the fair value of the net assets, which is 410,000. So how much is the goodwill working calculator? Who is the working calculator? How much is the goodwill? Yes, 14K. Phong. Net cepat lah. Okay, 14K is the goodwill arising from the acquisition of the control. So what is the entry? Okay, so on 1st Jan 2021, we will have to increase the investment in CAD for 221,500. And then credit cash, this is a consideration paid to increase the equity interest, 215,000. And then recognize the change in fair value of 6,500. So in the consolidated financial statement, debit goodwill 14,000, and then debit net asset of CAD 324,000, and then we have to take out the investment in CAD. This is to take out the whole, eliminate the whole investment, including the previously held interest. So 338,000. So this is from associates to subsidiary. So if there is changes in ownership interest within control entities without losing or without changing the control, then there will be no book value profit or loss. We will only need to adjust the carrying amount of the parent and also the NCI investment to reflect the change of ownership interest. So any difference between the fair value paid or received for the additional interest and the carrying amount of the additional interest will be recognized directly in the parent entity equity. So which means that if you increase the interest without losing or without changing the control, then there will no profit or loss in the book. All you need to do is to adjust the carrying amount of the parent and also the NCI. And any difference will be recognized directly in the equity, the parent's entity equity. So we look at this case study. On 1st Jan 2020, entity A holds 72% of entity B with a carrying amount of 154,000. And then 2 years later, they decide to acquire a further 21% for 65,000, which they hold total 93% of entity B. So as on this date, the carrying amount of the NCI with 28% shareholding is 73,000. So first, we'll have to determine what is the amount to be transferred to parent entity. So how do we determine we'll use the carrying amount of NCI and then divided by the original NCI ownership interest and then times multiply by the ownership interest acquired. That means we will use this carrying amount as at 1st Jan 2022 divided by 28%, which is the original shareholding of the NCI. And then we times the ownership, further ownership that we acquired, 21%. So we'll get the NCI to be transferred to parent company, which is for 54,750. So this formula is the same with the example just now, how we get the fair value of the existing interest. Everyone okay? Any question or anything you are not sure? If okay, can type in the chat box, okay? Yeah, Hang is okay. Melissa is also okay. Okay, seem okay. Okay, so I proceed further. Okay, Eric, okay. So I proceed further. So the next we will calculate the adjustment to parent entity. So we'll have to look at the consideration paid and then take into consideration of the amount to be transferred to parent entity, the NCI amount to be transferred to parent entity. So it's the amount to be adjusted to parent equity, because any changes in the fair value, any difference in the fair value and the consideration paid will be adjusted directly to parent entity's equity. So the consideration paid was 65,000, and then we minus by the NCI to be transferred to parent entity, 54,750, and then we get the amount to be adjusted to parent equity is 10,250. So under consolidated financial statement, we take out the NCI, debit NCI, non-controlling interest, 54,750, and then we adjust our equity, means the retained earning, our retained earning, 10,250, and then we credit cash, 65,000. Okay, so after we look at the additional interest in the investee, so now we look at how about we dispose our interest, partially dispose. This is about partially dispose without losing control. So if it is only partial dispose without losing control, then the changes will only show only within equity. No gain, no loss to the group, or there is no change in the goodwill, or there is goodwill relocation or reserve relocation. It will only reflect in your equity. So we look at the example, with partial dispose without losing control. So on 1st Jan 2019, Colors Limited has a 100% interest in Green, with a cost of investment is 186,000. So the Green net asset were 150,000. So the next day, Colors want to dispose 30% of his share in Green to go for 50,000. So they want to decrease their shareholding from 100% to 70%. So they didn't lost their control. They are still the holding company. So first we have to calculate the adjustment to equity. So we use the consideration received from gold 50,000 minus by the carrying amount of NCI. So the NCI here we will measure by the proportion of net asset. And then we got the movement in consolidated equity. So the fair value was 50,000. So how much is the carrying amount of NCI? Can anyone type in the chat box? How much is the carrying amount of NCI? How to get the NCI based on proportion of net asset method? Yes, 45K. So how do we get this? Yeah, Lim, yes, Y chain 45K. How do we get this? We use the 150,000 times 30% share NCI. Yes, yes, true. Wow, okay. So 50,000 minus 45,000, then we get a movement in consolidated equity is 5,000. So entries for this adjustment, debit cash for the cash consideration received, and then credit to equity 5,000, and then we credit the non-controlling interest 45,000, because previously 100% there is no non-controlling interest, but now there is. Okay. So this is without losing control. So any adjustment will be directly adjusted to equity. So how about if there is loss of control? Meaning the holding company dispose their interest in subsidiary, it become the passive investment or become an associate. So they will have to remeasure the retained interest to fair value on the date that the control is lost. And also the fair value is reflected in the calculation of the gain or loss on disposal. So they will need to remeasure the retained interest to fair value, and then they will need to calculate the gain or loss on disposal. So when a parent entity lost control of a subsidiary, it will have to derecognize the assets and liability of the subsidiary at their carrying amount. And then they will have to derecognize the carrying amount of non-controlling interest. They will have to take out their assets and liability and also the non-controlling interest from the consolidated financial statements. So they recognize the fair value of the consideration received and also if there is any distribution of share. So this is because they might distribute the share of the subsidiary to owners in their capacity as owner. So if there is any distribution of shares, they will have to recognize in the account and also recognize any investment retained in the former subsidiary at its fair value. And any difference will be recognized as a gain or loss in P&L. So we look at example. On 1st Jan 2018, Tiger Berhad acquired 75% equity interest in Dock Sdn Bhd. So they paid a cash consideration of 120K, and the NCI was 37,500, and the net assets of Dock was 150K, and the goodwill was 7,500. So after 3 years, they decide to sold 60% of the stocks equity interest and retain only 15% holding interest. So the consideration for the transaction is 110,000. The fair value of the retained interest is 30,000. The net asset of DOC on the date of disposal was 180,000, and the goodwill is the same, 7,500. So how do we calculate the gain on disposal on the of the 60% equity interest? So in Tiger books, we will have to recognize the gain on disposal. So we use the fair value of the consideration received, which is the 110,000, and then we added by the fair value of the retained residual interest, the retained interest, the 30,000, and then we less the carrying amount of the investment, which is 120,000. So there's a gain of 20,000 in Tiger's book. So in their book, they will recognize the cash received 110, credit to gain on sale of investment 20,000, and then credit their investment in DOC to write down the value from 120 to 30,000. So they credit investment in DOC 90,000. Okay, everyone okay? Any question? Yes or no? Okay or not okay? Yeah. But Cheng say no question, the rest okay? Okay, then if company level is okay, then we see group level. So in consolidated financial statement, we'll also have to calculate the gain or loss on disposal of 60% in equity interest. So the same, we use the fair value of the consideration received, 110K, and then added by the fair value of the residual interest, 30K, and we have to consider also the carrying amount of NCI, which is 45K. Then we minus the fair value of the net asset, total net fair value of the net asset of DOC, 180K. And also we minus the goodwill on consideration, 7,500. So in the consolidated financial statement, there's a loss of 2,500 for the disposal. So the entries in consolidated financial statement will be, we recognize the cash receipt of 110,000 debit cash, debit investment 30,000, and then we have to recognize the loss on disposal 2,500, and then they recognize the written down the NCI interest, non-controlling interest debit 45,000, and then we credit goodwill, take out the goodwill, and also take out the net assets of DOCs 180,000. So this is the entry in consolidated financial statement. We have to take out everything of DOCs from the consolidated financial statements. Okay, so if everyone is okay, no question, it's okay. I will give you time to digest and also to raise question. So now we have a short break, a 15-minute short break. We will come back at 11:50. Okay. So if any question, you can type in the chat box. We will discuss about it after the break. Thank you, everyone. Hello. Is everyone okay, ready for the next session? Everyone come back already? Can interact me in the chat box. Are you ready? Yes. As the yes, how about others? Kikyong, Chu, and also Tan. Okay, yes. Okay. Okay, come back already, yeah? Okay, so we start the next session. So just now we cover all about the passive investment, associates, and also subsidiary, and how do we do the consolidation. So now we move to another types of business combination. So this is about joint arrangement. So what is joint arrangement? So joint arrangement is parties to a joint arrangement recognize their rights and obligations arising from the arrangement. So the parties are bound by contractual arrangement. So the contractual arrangement gives two or more parties to joint control of the arrangement. So normally the ownership in a joint arrangement will be within 20 to 50% range. That means the party will be involved 2 to 5, normally like 2 to 5 in a joint arrangement. Okay, so we look at one case study, what is joint arrangement. So this is and also the contractual agreement. So this is D Sdn Bhd and E and F Sdn Bhd. So they for D he hold 62% ownership in DEF Sdn Bhd, and E Sdn Bhd hold 28% share, and F hold 10% share. So three parties they form a joint arrangement of DEF Sdn Bhd. This is an entity joint controlled by them. So DEF Sdn Bhd is the principal activities of DEF is hydrocarbon exploration and production activity. So under the contractual arrangement, all of the parties have to approve the operating and capital budgets of DEF Sdn Bhd. That means D and E and F Sdn Bhd will have to approve the operating and also the capital budget of DEF. So does D Sdn Bhd have control over DEF Sdn Bhd? Yes or no? Please type in the chat box. He has 62% ownership. Does he have the control over DEF Sdn Bhd under this joint arrangement? Yes or no? Eric say no. Alexander say yes. How about others? Some no one, yes. Mu say no. Tan say yes. Okay. Wow, this is debate, huh? Yes or no? Tan say no. Ching Ting say no. Wow. Okay. More and more people say no. So yeah, Han Wei also say no. Chu also say no. Okay. So why? Why no? No. Answer is no. D doesn't have the control because under the contractual arrangement, all of the party have to approve and the operating and also the capital budget. So E Sdn and F Sdn Bhd have the power to block the decision. So they have joint control over the relevant activities of the arrangement. So this is joint arrangement. So under joint arrangement, they have the joint control over the entity. No single party is in the position to control the entity. So other than the example just now, there there's other contractual agreements such as the entity duration and also the reporting obligation of the joint arrangement will have to state it clearly in their contractual agreement, and also the appointment of the board of directors and the voting rights and capital contribution by the party, and also the sharing of the output, income and expenses or the result of the joint arrangement. So these are the example of the items that will be included in the contractual agreement for a joint arrangement. So there are two types of joint arrangement. One is joint venture and one is joint operation. They are both bound by the contractual arrangement, which is the contractual agreement. So what is the difference of joint operation and also joint venture is we have to identify whether there is separate vehicle for the arrangement. If there is no, then it is most likely is a joint operation. If it is yes, then we have to consider the venture rights and obligation from legal form, from the terms and contractual agreement, and also other facts and circumstances. So if they have the rights to assets and obligation for liability, it is a joint operation. If it is they have the rights to net assets, then it is a joint venture. So other than this, the difference of joint operation and joint venture is also we have to consider the output sales restriction. If the output is sold to the joint arrangement parties only, then it is a joint operation. If it can be sold to anyone, then no restriction, then it is a joint venture. And the cash flow is mainly from the joint arrangement party, then it is a joint operation. If they can source from external party, then it is a joint venture. And lastly, the expected result is if under joint venture, they will expect break even or loss funded by the joint arrangement party. But under joint venture, the intention is to make profit so that they sell the goods to anyone, to third party, as long as there is profit. So now we do some exercise. So what is this joint arrangement? Associate A construction and B construction, they form a AB construction. So AB construction is jointly controlled by two parties, and they construct and sell the resident units to the public. Both of the parties have no rights to the assets or obligations for the obligation. And the contributed equity by the party is to buy the land and also raise debt finance for the construction. And the sales proceed is to repay the external debt. And also the remaining profit will be distributed to the party, to A construction and B construction. So, and then the last one is the parties to the arrangement provide a guarantee to the financier. So what is this arrangement? Joint venture or joint operation? Anyone can type in the chat box. Joint operation, Chen said. How about others? Joint operation or joint venture? Sim say joint venture, Esther say joint operation. The rest? Joint venture. Qingting say joint venture. Why change joint operation? Wow. This is also a debate. Hang say joint venture. So 3 joint venture, 3 joint operation. Any more? JV. Now 4 for JV. Okay, 6. Okay, how? And then now we see what is this. This is joint venture because they can sell the unit to the public. although they don't have rights to the assets or obligation, and they raise debt from external. And also they provide a guarantee to the financier. So we come back to this. If under joint venture, they can sell to anyone, but under operation, they can only sell to joint arrangement party. And the finance source, this is from internal only, and this is can be financed through third party, external. So we look at one more. C manufacturer and D manufacturer, they form a CD manufacturer. So C and D also have no rights to the assets and obligation for liabilities. And C and D will each purchase 50% of the CD manufacturer output. CD cannot sell any outputs to third party without the approval of C and D. So the price which C and D will pay for the output will cover the production and also the administration costs. So what is this arrangement? Operation or joint venture? JO, Mu say, Sim say, JO. Michelle also say joint operation. Eric say joint operation. Yeah, obviously this is joint operation. Yeah, Kelly, yes. Yes, Jingting joint operation. Yes, Liu, because they will have to purchase the output of CD manufacturer. And they cannot sell, CD manufacturer cannot sell to third party without their approval. And the price they pay for the output is the cost of production and also the administrative cost. That means they will only break even the financial performance. So obviously, this is joint operation. So the accounting treatment for joint venture will be using equity method, just like associate and also subsidiary. For joint operation, in their books, they will only account for the share of assets, liability, revenue, and expenses. So this is all for joint arrangement, which is also we commonly call joint venture or joint operation. So any question from the floor? If no, then we proceed to disclosure. So disclosure in financial statement is covered by these two standards. One is MFRS 12, interest in other entities, and also another one is IAS 27, related party disclosure. So under MFRS 12, the holding company will have to disclose the significant judgment and assumption used by the entity to justify whether they have the significant control or significant influence over the entity. And also they will have to disclose the associate and also joint arrangement disclosure and also subsidiary. So for related party disclosure, they will have to disclose the relationship and also balance and also the transaction. So for this, I will cover by one real case, which is a listed company, Hasco. We will look at how he disclosed all of this information in their audited report. So this is Hasco Berhad. It is a logistic company. So it has investment in associate company and also investment in joint venture. So under the under the accounting policy, they listed clearly that what is the basis for the consolidation, which we have also covered just now. We have to assess the power, we have to assess the exposure to variable returns and also assess the ability to use its power to affect the amount of the returns. So this is to determine the control. And so, and also, instead that in all the intra-group balances and transaction income expenses are eliminated in the consolidation. So if there is changes in the of the interest in subsidiary, so what we covered, this is what we have also covered just now. If there is a loss of control, so they will recognize the asset and also the liability and non-controlling interests, and recognize the gain or loss in profit or loss of the group to the group. So these are the accounting policy that will have to disclose in the report, and then under the notes to financial statement, for this investment in subsidiary. So for holding company, it will have to disclose the equity interest and also the name and principal activities of the subsidiary. So they will have to disclose all of their interests in the other entity. And if necessary like this, they will have to disclose there's a subsidiary that have material non-controlling interest. That means that they hold less than 50%, but it is considered as their subsidiary because they have the power over the entity. So this is what they have to disclose in their report. And also when they have lost control over the subsidiary, they also disclose here the recognition of a subsidiary. So why is it lost control? Because the company is under winding up. So they have to de-recognize the asset and also the liability. Then this is the implication. Loss on the recognition of the subsidiary. So for associate company, because for associate, we are also using the equity method. So we recognize at cost, and we also have to recognize the share of profit or loss of the associate company. So we also have to disclose the equity interest in the associate company. And how much is the group share of the result. So for joint venture, it's the same. We recognize the joint venture at cost, and also we associates, we also have to recognize the profit or loss from the joint venture, share of profit or loss. So they will have to disclose the nature of the joint venture, the principal activity, and the equity interest held by them. So these are the disclosure for interest in other entity. So for the related party transaction, we'll also need to disclose in the report. We'll have to identify all of the related party and disclose the transaction in the report like this: transaction with immediate holding company, the relationship, and also the transaction with subsidiary companies, and also transaction with associate company, transaction with joint venture company. So what are the transaction with them? For the balances that they disclose under the receivable and also payable notes to account. So it's not under this note. So I will share this material to you so you can refer to it later. So this company is very good because it has everything we cover today. So let's get back to our slide. Okay, so we cover the disclosure in the financial position. So this is all about our courses today. So we have covered first one, identify the types of investment, and then we determine the relevant accounting treatment for the investment, and also to apply the equity accounting method to do the consolidate investment and also assess the accounting impact of changing an interest in an investment. And the last one is disclosure requirement. So any question? Okay, I go back to the question raised by Wai Cheng just now about the advantages and the disadvantages of the control, even though the shareholding is less than 20%. So it cannot be said if there is any advantage or disadvantage, because it is a different thing from different perspective. So if the investor they want to have control over the entity, then they want to hold less than 20%, they can control through the power or the decision-making process. So they can appoint their related party to the board of director of the investee, or they can involve in the decision-making process. So it will make them have the power or the control or the significant influence over the entity. But if the investor just want to be a sleeping partner, they don't want to involve in the management decision-making process, or they don't want to involve in the policy making process, and then they just hold less than 20%, then it will be a passive investment. They just entitle the dividend and they do not need to be involved in the operation. So these are the difference between significant influence and without significant influence. So any other question? If you don't have question, then I have question to you all. If no, 5 seconds, 5, 4, 3, 2, 1. If no, then we move to assessment. So there are how many types of Alexander, I get back to you later. Okay, how many types of investment have we covered? How many types of investment have we covered? Yeah, Eric. Yes, Moo. Yeah, thank you for paying attention. Then the next, what is significant influence? You can list all of the things you know, or can simply type a short form, and then I try to understand what is significant influence. You can also Google and copy and paste. Yeah, voting right more than 20%. Yes, this is the most direct answer. Yeah, power to influence the decision making. Yeah. Any other answer? Right, significant influence other than the voting rights, other than the power to influence decision making, material transaction. Yes, representation in BOD. Yes, very good. Wow. Yeah, and also the interchange of managerial personnel, and also the provision of essential technical advice. Yeah, yes. Yeah, thank you for paying attention to the training. And the next question, what is control? What is control? What do we assess for control? Voting power. And then what else? We assess power and then voting rights, potential voting rights. Yes, contractual agreement. Yes, yes. Yeah, very good. Okay. So control also includes the ability to affect the returns and also the exposure to the return. Okay, so what is consolidation? The last one, what is consolidation? This is not in the slide, but I have mentioned about 2 or 3 times earlier. Yeah, combination of the financial result. Yes. Combine parents and company and subsidiary company. Yes. Yes, combine the result of parents and subsidiary company. Yeah, well done, everyone. Thank you for paying attention. So now I return to the question raised by Alexander just now. Can I explain again about the difference between JO and JV? So JO and JV, okay. So now the first we have to determine whether there's separate vehicle for the arrangement. If no, then this is joint operation. If yes, then we will have to further consider the rights and obligation in legal form and also the terms of contractual agreement and other facts or circumstances. So other facts and also the contractual agreement are like this. So if the output can only be sold to the joint arrangement party, then it will be joint operation because there is only 2 parties join together to produce more product, and then the product can only be sold to the joint arrangement party only. So if it is joint venture, they can sell to anyone, not necessarily only the joint arrangement party. And then for cash flow source, joint operation can only source from the joint arrangement party only, from internal. But for joint venture, they can source through third party, through external party. And for the expected financial performance for joint operation, because they only sell the products to internal party only, so most likely their result will be break even or even losses. And the loss will be bear by the joint arrangement parties. But for the joint venture is 2 parties which aim to make profit. The intention is to make profit. So they join together and then to produce product and can be sold to anyone. So the intention is to make profit. So Alexander, is it clear or do you need further clarification? Under what circumstances a joint operation be formed? Okay, under what circumstances? So normally, it also depends on two parties. Maybe their productivity is limited. They have limited resources or they have limited manpower. So they join together to improve their productivity, to get more products. So they just form an entity or they just temporarily operate together to get more products. Then the products can only be sold to internal party only. So this is normally what we see from the market, they do the joint operation because they just want a temporary entity or a temporary cooperation with other party to improve their productivity. And then after that, they will split and do by their own. So this is joint operation. Or maybe it will be a long term, which they join together to produce the products, and then but the products can be sold to the arrangement joint arrangement parties only. So if to pool their knowledge and also the expertise together. Can it be formed between related parties? Yeah, related companies. Yes, can. There is no restriction whether who can form the joint operation or joint venture. It can be formed between the related parties also. They just need to have a contractual agreement. How long, what activities, and any reporting obligation. So who will be the director or who will contribute the capital. Okay, any other question? Okay, thank you, Alexander. Okay, so if anyone have any other question, you can always PM me. I will try to do research or answer you directly. So thank you for all of the participation today, and for the working calculator just now, I will arrange the special gift to you by next Monday. I will PM you later. Okay, so thank you for all of the participation, and I will see you guys maybe next week for preparation of consolidation. Thank you, everyone.